Hello, thank you for joining me today. My name is Briant Sikorski, and I'm an independent wealth advisor with Stratos Wealth Partners. As a wealth advisor, I help clients work toward achieving their financial goals by providing personal, business, education, insurance, and legacy planning. I provide access to investment solutions, which include stocks, bonds, and spiritual, moral, or socially responsible mutual funds and exchange-traded funds. Today, I will be presenting LPL Financial Research's Outlook 2015 in Transit, where we will look at forecasts for the economy and its impact on the stock and the bond markets. The title includes in transit because the U.S. economy continues a transition from a period of very slow gross domestic product growth from 2011 to 2013 to a more normative, sustained, broad-based growth. At the same time, central banks around the world are also going to be on the move in 2015 as they implement some of their monetary policies and economic stimulus. And while I'm not sure I agree with this one, apparently Washington is going to shift from a relatively quiet 2014 to take a bigger role in 2015. I'm not so sure if I agree that Washington has been quiet in the last year. If we look at our investment themes in transit, you'll see that stock prices in 2015 may potentially record their 7th consecutive year of positive returns. At the same time, the Fed will use the stronger U.S. economy to set the stage for embarking on late 2015 or early 2016 rate increases. On the other hand, central banks in Europe, Japan, and emerging markets are trying to kickstart the economy while easing their policies. We expect volatility to return to more normal levels after several years of below-average swings in equity prices. And we've only experienced 3 pullbacks of greater than 5% over the last 2 calendar years. And 2015 is promising to be a more bumpy road for investors than this past. As a preface, we look for 3% or greater growth in 2015. This would be our highest growth rate since 2010. We're looking for 5 to 9% returns on stocks. This is going to be tempered by increasing levels of volatility, and these returns are predominantly, we'll discuss, based on growth as opposed to valuation, which I think is important. And with the dual threat of the Fed's impending rise in rates and economic expansion, bonds are expected to offer little, if any, growth potential in 2015. Now, if we look at the economy, we can see that by historical standards, our recovery, which began in the mid-2009 timeframe, has been one of the most tepid recoveries on record, with GDP growth through the 3rd quarter of 2014 just 11% above its 2009 low. If we look at all recovery since the end of World War II, the economy expanded 24% on average in the first 5 years of recovery. The current recovery even lags the last 3, beginning in 82, 91, and 01, which we believe are the most comparable. 5 years into those recoveries, the economy stood 16% above its recession lows. So therefore, the pace of this recovery has thus far lagged behind those prior in each of the major GDP categories. At 65 months through the end of November 2014, the current recovery is the fifth longest expansion since World War II and is already longer than the average economic recovery since that time of 58 months. Looking back over the last 50 years, the average expansion has been 71 months in duration. Now, if we extrapolate from that, that would mean that today's current recovery may surpass the average sometime in the middle of next year, 2016. Now, several labor market indexes, which have been referred to as the Yellen indicators, are being closely monitored by the Fed chairman and the Federal Open Market Committee, or FOMC. Now, these results are likely to impact future monetary policy. Over the course of 2014, the Fed Chair, Janet Yellen, has mentioned several labor market indexes that she and other Federal Open Market Committee members are watching closely. And this kind of infographic shows us the details of the performance of a broad range of indicators since the mid-2000s. Although most metrics have partially recovered from their Great Recession lows, only a few have really returned to, quote, normal. And until they do, or at least until they make sufficient progress towards that normal, markets should expect that the Fed will be content with keeping its Fed funds rate target near zero. So we really don't see a rise of rates until later this year, or perhaps even 2016. And we can see some of these measures in the underemployment or unemployment categories, the employment and work, the job market environment, and finally layoffs and quits. Now, stocks should, quote, deliver the goods, and we're looking for 5 to 9% returns in the overall market, as typically measured by the S&P 500. And these cycles that we are in transition can also cause potential fluctuations and volatility, even if they've historically provided solid stock market performance. The most important cycle, the economic cycle, is unlikely to reach a recession in 2015, positioning the stock market to potentially offer up solid gains to investors. Since 1950, in years which the U.S. economy does not enter a recession, the odds of a positive year for the S&P 500 were 82%, with an average gain of 11%. Now, with earnings pointing higher and not valuations doing the heavy lifting in producing potential stock market gains for investors this year, we look at steady, though not spectacular, economic growth in the U.S. and mixed but largely stable growth overseas, supporting continued low to mid-single-digit revenue growth for the S&P 500. Now, as this cycle advances further, cost pressures may begin to emerge and limit companies' ability to continue to expand their profit margins. However, with limited wage pressures, currently low commodity prices, and low borrowing costs, profit margins should remain relatively stable. In addition, share buybacks by corporations, though slowly, may continue to lift the earnings per share calculation. Based on this, we believe the S&P 500 is on schedule to potentially deliver a year of high single-digit earnings per share growth, a pace consistent with the signal from our favorite leading earnings indicator, the Institute for Supply Management Purchasing Managers Index. So the key here is that the rise in stock prices is being attributed to earnings growth, and not just because individuals are feeling that stock prices should just be higher normatively. Now, with monetary policy also in transit for 2015, when stocks will face a transition from very loose monetary policy of the Fed's quantitative easing program, which ended in October of last year, to possibly an environment in which the Fed begins to consider hikes in interest rates. This transition may contribute to an increase in stock market volatility short term, but we don't expect the Fed to start raising rates to derail the stock market this year. In fact, history has shown that stock performance, even when the Fed began to hike interest rates due to better economic and profit growth, stocks still increased. So we still, if we look at and assume that 2016 is a year of a rate hike, we can see that previously 9 out of 9 years, the prior year, which this would be, resulted in positive stock returns. Now, valuations of the S&P 500 remain slightly above the long-term average of between 16 and 17 times trailing earnings, indicating a slightly expensive market. However, valuations have had virtually no predictive power in timing market tops or major pullbacks. Over long time periods, such as the next 10 years, PE ratios have a strong historical record of forecasting the market directions. So this PE ratio, which we know is a valuation ratio of a company's current share price compared to its per share earnings, suggests that investors are expecting higher earnings growth in the future when compared to companies with lower PE ratios. So supported by business spending, we expect cyclical stock sectors, which in the past have historically performed well during the middle and late stages of the business cycle. Among cyclicals, companies in the industrial, technology, and transportation sectors have been especially well poised to ride out improved economic growth to better earnings and price returns. Now, in the past, we've had relative underperformance of small company stocks, particularly during the latter half of last year, and we think this may present an attractive opportunity in 2015. This is based on these companies' U.S.-based exposure and potential to participate in market upside. We favor U.S. stocks for better growth and the trajectory of that growth relative to developed foreign equity markets. Structural change in Europe, along with the potential for additional easing measures, may increase and create additional opportunities in 2015. So we view emerging markets as an attractive opportunity due to their favorable valuations, strong demographic trends, and the potential for stimulus to drive their improved growth. Now, we've talked about the return of volatility, and if we look at an increase in volatility, especially in the latter stages of an economic expansion, is quite common. Pullbacks in equity prices are frequent occurrences, and they actually showcase a healthy relationship in the tug-of-war between buyers and sellers. In fact, during this current bull market that started in March of 2009, in which the S&P 500 has delivered a 236% cumulative return as of this past October, there have been 20 modest market pullbacks of 5% or more. During the 1990s bull market, there were 13. In 2002 to 2007, there were 12. So considering the average of 3 to 4 pullbacks a year, the last couple of years have been uncharacteristically quiet, but that's likely to change this year. Now, how do we know if a recession is on our doorstep? I always get that question, is a recession right around the corner? Well, when we look to recession, we look for excesses in the market and economy by examining the 5 forecaster, which are data series that have had a statistically significant historical track record of providing warning signs that we are transitioning to the fragile late stage of an economic cycle. So once we receive these signals, on average, we can expect a recession within the next 6 to 12 months. Now, at the time, we really don't see any signals out there for a recession to rear its head in 2015. So investment ideas that we can consider in diversifying portfolios, merger arbitrage may be an investment to consider. It involves investing in companies seeking really transformational events through mergers or acquisitions. And they will typically have an ability to produce low correlations to stocks and bonds, and at the same time have a relatively low risk profile, more normally considered with fixed income. Now, with interest rates at near all-time lows and the prospects for more restrictive monetary policy, this is going to keep our bond returns lower. Now, on the other hand, fixed income still remains one of the best diversifiers of an equity market downturn. Finally, global macro is a broad strategy of macroeconomic analysis and forecasting to assess future economic trends and their impact on equity, bond, currency, and commodity markets. So this should be also a prime area in which we could consider diversifying. Now, I mentioned at the outset that we're looking for flat if not negative bond returns. We can see here that a 0.25% to 0.75% rise in bond yields translates to lower, marginally negative low returns. So we can see that when we had a rise of 0.25%, we can see that bonds have returned only 1.91%. But on the other hand, when bond yield of 0.75% were implemented, we can see that bonds actually went negative, a negative 0.87% total return. Now, valuations also remain expensive across the bond market, and this provides very limited opportunities for investors. Inflation-adjusted yields remain well below historical norms and really illustrate how expensive bonds remain. So we've had a scenario over the last several years since some of the economic stimulus that were implemented after the downturn in 2008. This has caused bond prices to very abnormally rise in principal value, making them very, very expensive. Now, on the other hand, we've had high single-digit earnings growth through the first 3 quarters of 2014 and low defaults. Now, that's great because it suggests the ability of corporations to repay their debt obligations and remain strong through this next year. The municipal bond market could likely experience another year of limited net growth and should provide a tailwind for relative returns. The Fed's journey to increase interest rates actually began way back in 2013 with a taper talk and has been widely anticipated, which should limit the potential surprise to investors. A sharp decline in bond prices and spike in yields is very unlikely, and we expect a gradual move towards higher interest rates. While the 10-year Treasury is a beacon of yield relative to most other developed nations, the gap between the yield of the 10-year Treasury and the 10-year German Bund recently reached record levels, with the additional yield being greater than 1.5%. So some of our bond ideas expected to deliver in 2015 would include high yield bonds. These are bonds of companies with less than perfect credit quality. On the other hand, their credit quality has remained stable, and we've had a very low percentage of defaults. Their corporate balance sheets remain strong, and the increased yield has created a buffer against price declines associated with rising interest rates. Among high-quality bonds, municipal bonds and investment-grade corporate bonds have offered modest value. And finally, in the recent midterm congressional elections, the Republican Party won a majority in the Senate and increased its advantage in the House. So this sets up a slightly different policy dynamic in Washington than the one that's been in place since 2006. This transfer of power, if you will, to the Republican Party could have a meaningful impact on broad policy measures such as the Affordable Care Act, tax reform, and presidential appointees to the Fed, as well as several key sectors of the economy. Accordingly, after a relatively quiet, quote, 2014, we expect Washington to be front and center again in 15. So I think the most important delivery, if you will, from activity in Washington, shifts in monetary policy, we look at the most important delivery as a setting of the stage for 2016 with continued strong economic growth, improving labor conditions, a continued environment for fast-growing corporate earnings, and a favorable backdrop for expanding equity prices. So in summary, we can see our forecast of 3+% economy growth, 5 to 9% returns in stocks, and flat returns in the bond market. If you'd like to read the detailed report that accompanies this presentation or learn more about me, please do so at my website at BriantSikorski.com, BriantSikorski.com. You'll see here on the middle right-hand side, it says LPL Research's Outlook 2015 in Transit. And if you look down here and click on this hyperlink, read the complete Outlook report, you can read all of the detail behind the presentation that I just gave you. You can also review additional financial information as well as access my Facebook, LinkedIn, Twitter, and YouTube pages where you'll find this recording. With that, I'll say thank you very much and have a great rest of your day.